Alibaba Group Investment Summary. Alibaba Group Holding Limited, through its subsidiaries, provides online and mobile commerce businesses in the People's Republic of China and internationally. It operates through 4 segments: core commerce, cloud computing, digital media and entertainment, and innovation initiatives. The company operates Taobao Marketplace, a mobile commerce destination, Tmall, Alibaba Health Internet, Alimama, 1688.com and Alibaba.com, Lazada, Tmall Global, Cainiao Network Logistic Services, ELE.me, Koubei, and Fliggy. If I pronounced any of those incorrectly, I apologize. In addition, the company offers pay-for-performance and display marketing services, Taobao Ad Network and Exchange. Further, it provides elastic computing, database storage, virtualization network, large-scale computing, security, management and application, big data analytics, and Internet of Things, and other services for enterprises, payment and escrow services, movies, television series, variety shows, animations, and other video content. The company operates Youku, Alibaba Pictures, Amap, DingTalk, Tmall Genie, and the company was founded in 1999 and is based in Hangzhou, the People's Republic of China. So now we have to get into a bit of a general overview of Alibaba. Alibaba went public in 2014 on September 1st to the New York Stock Exchange. Alibaba is known as the largest IPO in Chinese history. At the time of the IPO, Baba was valued at $21.8 billion. Just 4 days after the IPO, the company's market cap grew to a staggering $25 billion. Since the IPO, the stock's price has increased 126%, which is relatively similar to the Chinese competitor JD.com, ticker symbol JD, which grew 186% since Baba IPO'd in 2014. Both of these growth statistics are more than 250% below the returns of the Nasdaq, QQQ, ETF SAW, and the S&P 500 SPY offered over 1,600% returns and is almost 1,400% higher than either Baba or JD. Alibaba is currently trading at 5.4 times their trailing 12-month sales. Trailing 12-month, or TTM, refers to the past 12 consecutive months of a company's performance data used for reporting financial figures. By consistently evaluating the trailing 12-month numbers, companies' financials can be evaluated both internally and externally without regard for their artificially of fiscal year end. This current 5.4 times the trailing 12-month sales makes Alibaba relatively cheap, especially when you consider that Tencent, Alibaba's arch rival, trades at almost double that multiple. For now, Alibaba can draw on its strong balance sheet if it needs to. The company had $72 billion in cash equivalents, and short-term investments as of March 31st, giving it plenty of firepower to fuel its side bet. But even then, there's no guarantee Alibaba's unprofitable business will ever turn a profit. And if they don't, Alibaba will ultimately need to write off these investments, destroying their personal shareholder value. Now, this being said, them relying on their balance sheet is because right now the general strategy of Alibaba is a little bit unprofitable. But with that being said, they do have ways that they could make this profitable. So maybe right now in the short term they aren't very profitable, but they could be because they're looking for the short-term growth in the market share and growing the profitability in the longer term for now. Now, we do have a positive and negative sections later for Alibaba, but first I want to dip into some additional information, which first is their subsidiaries. We talked about a few of them in the beginning of the video, and right now I want to go over each one, starting with Alibaba.com. The first business of Alibaba Group is Alibaba.com. It's China's leading integrated international online wholesale marketplace in 2019 by revenue, according to analysis. It connects Chinese and overseas suppliers to overseas wholesale buyers who are typically trade agents, wholesalers, retailers, manufacturers, and SME engaged in the import and export business, and providing sourcing, online transaction, digital marketing, digital supply, chain fulfillment, and financial services to them. In the 12 months ended March 31st, 2020, over 20 million buyers from approximately 190 countries had sourced business opportunities or completed transactions on Alibaba.com. The next we have is Taobao Marketplace. Hopefully, again, that's being said correctly. Launched in 2003, Taobao Marketplace Taobao.com provides consumers from both large cities and less developed areas with an engaging, personalized shopping experience optimized by big data analytics and technology. Through highly relevant and engaging content and real-time updates from merchants, consumers can learn about products and new trends. They can also interact with each other and their favorite merchants and key opinion leaders. Merchants on Taobao Marketplace are primarily individuals and small businesses. According to analysis, Taobao Marketplace was China's leading mobile commerce destination with a large and growing social community in terms of GMV for the 12 months ended March 31st, 2020. Next is Tmall. They were launched in 2008 with Tmall.com. They cater to consumers' ever-growing demand for high-quality products and premium shopping experience. It serves as a platform for consumers in China and overseas to buy both homegrown and international branded products, as well as products not available in traditional retail outlets. A large number of international and Chinese brand and retailers have established storefront on Tmall. In the 12 months ended March 31st, 2020, Tmall was the leading third-party online and mobile commerce platform for brands and retailers in the world in terms of GMV, according to analysis, and continues to grow quickly. Next, we're covering Free Shipout, which was launched in 2016. Free Shipout is Alibaba Group's proprietary grocery retail chain. It exemplifies the creation of new shopping experience through the convergence of online and offline activities by using retail stores to warehouse and fulfill online orders, in addition to offering a rich and fun experience for consumers who shop in store. Its proprietary fulfillment system enables 30-minute delivery to consumers living within a 3-kilometer radius of a Free Shipout store. Free Shipout offers a mobile platform that allows consumers to search for products and place orders while browsing in-store. As of March 31st, 2020, Alibaba had 207 self-operated Free Shipout stores, primarily located in Tier 1 and Tier 2 cities in China. This is similar to a service that is offered in the United States, like an Instacart, if anybody has used one of those. Next, we have AliExpress, launched in 2010 with AliExpress.com. It is a global marketplace targeting consumers from around the world and enabling them to buy directly from manufacturers and distributors in China and around the world. In addition to the global English language version, the AliExpress platform is available in 17 other languages, including Russian, Portuguese, Spanish, and French. Top consumer markets where AliExpress is popular are Russia, the United States, Brazil, Spain, and France. Next is Lazada. Founded in 2012, Lazada is a leading and fast-growing e-commerce platform in Southeast Asia for SMEs, regional and global brands with a presence in 6 countries: Indonesia, Malaysia, the Philippines, Singapore, Thailand, and Vietnam. Lazada provides customers with access to a broad range of offerings, serving over 70 million unique customers in the last 12 months, ending March 31st, 2020. More than 75% of Lazada's parcels went through its own facilities or first-mile fleet during the same period. 1688.com is next on our list and launched in 1999. It's China's leading integrated domestic wholesale marketplace in 2019 by revenue, according to analysis. It provides sourcing and online transaction services by connecting manufacturers and wholesale sellers to wholesale buyers in China who typically trade in apparel, general merchandise, accessories, home decoration, furnishing, materials, and packaging materials, among others. Next is ele.me, which means, "Are you hungry?" in Chinese. Hopefully that's correct. In leading on-demand delivery and local service platform in China, it enables consumers to use the ele.me, Alipay, Taobao, or Koubei mobile apps to perform order meals, snacks, beverages, fresh foods, and groceries online. In addition, Cainiao Logistics, LAE.me's on-demand delivery network is a specific synergistic with Alibaba's digital economy and provides last-minute logistics services to facilitate new retail initiatives, including delivery services for Fresh Shippo, as well as Alibaba Health. Alibaba Group acquired ele.me in 2018. Next is Youku. It is the third leading online long-form video platform in China in terms of monthly active users in March of 2020, according to Quest Mobile. It enables users to search, view, and share high-quality video content quickly and easily across multiple platforms. The Youku brand is among the most recognized online video brands in China. Insights Alibaba gains from its retail commerce business and its proprietary data technology enable Youku to deliver relevant digital media entertainment content to its users. At the same time, Youku helps drive customer loyalty to Alibaba's core commerce business in the form of complementary content offerings for users. Alibaba Group acquired a controlling stake in Youku in 2016. This basically shows how interconnected Alibaba is, using insight from other things such as their big data analytics to help further their other businesses to hopefully be more profitable in the future, or just gain more market share, get more eyes on them, because the more eyes, the more money. DingTalk is next. DingTalk is a digital collaboration workplace that offers new ways of working, sharing, and collaborating for modern enterprises and organizations, including schools and education institutions. Millions of enterprises and users use DingTalk to stay connected and work remotely. According to Guess Mobile, DingTalk is the leading business efficiency app in China by monthly active users in March 2020. Next is Alimama, which was launched in 2007. Alimama.com is Alibaba's group monetization platform using data technology. It matches the marketing demands of merchants, brands, and retailers with the media resources on Alibaba's own platforms and third-party properties, and enables Alibaba to monetize its core commerce, digital media, and entertainment, and other businesses. Alimama also has an affiliate marketing program that places marketing displays on third-party apps and websites, therefore enabling marketers, if they so choose, to extend their marketing and promotional research to properties and users beyond Alibaba's platforms. Next is Alibaba Cloud. Established in 2009, Alibaba Cloud, or AlibabaCloud.com, is the digital technology and intelligence backbone of Alibaba Group. It offers a complete suite of cloud services to customers worldwide, including elastic computing, database storage, network visualization services, large-scale computing, security, management and application services, big data analytics, a machine learning platform, and IoT services. Alibaba Cloud is China's leading provider of public cloud services by revenue in 2019, including PaaS and LaaS services, according to IDC. Alibaba Group is the world's third leading and Asia Pacific's leading IaaS provider by revenue in 2019 in US dollars, according to Gartner's April 2020 report. And last but not least is Cainiao Network. Established 2013, Cainiao, probably incorrect there, is dedicated to meeting Alibaba's group's logistics vision of fulfilling customer orders within 24 hours in China and within 72 hours everywhere else in the world. To realize this vision, they must continue to build and operate a global fulfillment network together with logistics partners. It offers domestic and international one-stop shop logistics services and supply chain management solutions, addressing various logistics needs of merchants and consumers at scale. This basically means, because it was a very fancy way of saying everything, that they want to be able to fulfill orders, basically delivered to you within 24 hours anywhere in China, which is a hard thing to do because of how vast the country is, and then 72 hours everywhere else in the world, which again is difficult because some places take up to 20 hours just to get goods there. And they are hoping to build this into a great thing. That way they can have other people go through their fulfillment centers for obviously some sort of fee to increase how much revenue they're going to be getting and just have a worldwide control over logistics centers. Now, before we get into the positives and negatives of Alibaba, we first have to look at the overall e-commerce in China and what that's going to be looking like. Now, the e-commerce market in China is set to register a strong compound annual growth rate of, or CAGR, of 12.4% from 13.8 trillion or 2.1 trillion US dollars in 2021 to 19.6 trillion in CNY or $3 trillion in US dollars by 2024, forecasts Global Data, a leading data and analytics company. According to Global Data's e-commerce analytics, e-commerce sales in China are expected to register a robust growth of 17.2% in 2021 as consumers increasingly shift from offline to online due to the COVID-19 pandemic. According to the National Bureau of Statistics of China, while the whole total retail sales of consumer goods in the country declined by 3.9% in 2020, online retail sales of physical goods increased by 14.8% during the same period. In the fourth quarter of the fiscal year 2019, Alibaba had 654 million active shoppers on its online shopping platforms in China. In comparison, Pinduoduo had 443.3 million active shoppers, and JD.com had 310.5 million active shoppers. Amazon has 300 million active shoppers on its marketplace, Investopedia. gave us this information, and it shows just how vast Alibaba's just straight network is of having users on a platform, having over double what Amazon has. Alibaba has been crucial in introducing overseas brands to the country. While Alibaba will be successful in its quest for more international growth, its ongoing issues with counterfeiting could stymie some of its expansion. And just to show how great the e-commerce market in China is, these are the largest e-commerce markets in the world. We have 3 of them here, third being the United Kingdom. Despite its small size, the United Kingdom is a big e-commerce player and comfortably secures the 3rd spot on this list. Amazon UK, Argos, and Play.com are the UK's biggest e-commerce websites, and the country also has one of the highest percentages of total retail sales in e-commerce. Number 2 is the United States. After ruling the e-commerce world for more than a decade, the United States is currently the 2nd largest e-commerce market in the world. Led by e-commerce giants Amazon and eBay, the US observes healthy e-commerce growth in all sectors and, for the most part, has been the innovation house of the new e-commerce trends. And the largest is, obviously, as we're talking about it, number 1, China. Today, China is the world's biggest e-commerce market, led by e-commerce subsidiaries of the Alibaba Group, namely Taobao and Alibaba.com, Tmall, and others. With an annual growth rate of 35%, China is also one of the fastest growing e-commerce markets in the world. And for the last topic before our positives and negatives section, we have the competitors. China maintains the world's largest online retail market, much larger than the online retail market in the US, as the middle-class population of China has grown and there is more of a desire for international brands among Chinese consumers. First, we have JD.com. JD has currently a price-to-earnings ratio of 14.69 compared to Alibaba's price-to-earning of 33.12, nearly half of it. JD's 6-month monthly return is negative 12%, and the 5-year return is 159.77%. Alibaba's 6-month return is negative 17.50 because of the recent drop, and Alibaba's 5-year return is 239.19%. Now, JD began as a single store in an electronics bazaar in Beijing and has evolved into one of the largest e-commerce companies in China. The consensus estimate for looks at JD to report $148 billion in revenue this year, up about 30% from last year. JD's offerings are very similar to that of Alibaba subsidiaries offer, and the company has achieved double-digit revenue growth every quarter going back to several years and has been consistently profitable. JD.com reported better than expected first quarter earnings on May 19th that beat views on the top and bottom lines as revenue jumped 39% to $31 billion. That beat estimates of 29.8. It reported adjusted earnings of 38 cents versus estimates of 35 cents. That is per share. The next competitor that we will look for is Amazon.com. Amazon and Alibaba have become notable players in the market by operating through an online presence alone. While Amazon and Alibaba each have distinct features that make them purely e-commerce companies, their respective business models differ greatly. Amazon is a massive retailer for both new and used goods, and Alibaba operates as a middleman between buyers and sellers. Often touched as the largest online retailer in the world, Amazon operates a business model with many moving parts. First and foremost, the company sells goods directly. A percentage of products are offered to buyers through Amazon's online storefront with a small markup, and inventory is kept in the company's largest network of warehouses. Amazon provides a platform for other online retailers to sell to buyers. Products sold through Amazon's partner retailers are often less common items or those with a higher purchase price, allowing Amazon to avoid holding slow-moving inventory that could dilute their profit. Both Amazon and Alibaba operate in two of the world's most competitive e-commerce markets. Amazon has nearly 300 million active users. That's twice the entire population of Russia. Nearly 2/3 of Americans have bought something from Amazon. That's more than 90% of US online shoppers. Amazon made $141.25 billion in retail product sales. This comes to an average of 385 million per day. Now, the key takeaways from this is Amazon and Alibaba both have e-commerce giants operating largely without physical stores. Amazon dominates the American shopping space, while Alibaba does the same thing, but in China. Amazon sells directly while also serving as an intermediary for sellers, taking a cut of the sales, whereas Alibaba charges merchants fees to appear higher on its search rankings. And now we will wrap it up finally with the positives and negatives. Now, for the positives, in 2019, Alibaba averaged 881 million monthly average users, and in 2020, that grew to 902 million monthly average users. Alibaba's annual revenue for 2021 was $109.48 billion, a 52% increase from 2020. Alibaba's annual revenue for 2020 was nearly $72 billion, a 28.2% increase from 2019, and Alibaba's annual revenue for 2019 was $56 billion, a 41% increase from 2018, showing a consistent improvement and above expectations. The company is currently trading with a 24.36 price-to-earnings ratio, multiple PE, over the last 5 years. Alibaba's average price to earnings is 39.14. This is showing that even though the downtrend the company has maintained in its earnings, it is one indication of the stock being undervalued. If we compare this to other companies such as their local competitor JD has a 14.95 price to earnings, and their biggest competitor Amazon has a 66.27 price to earnings. And a company with a similar market cap, Tesla, has a 628.15 price to earnings ratio. Alibaba was founded in 1999, and just 3 years later, 2002, the company became profitable. This was 12 years before the company went through the New York Stock Exchange. Since at least 2017, Alibaba has been able to grow their earnings per share every year. In 2021, it's 8.35. In 2020, it was only 7.9. And in 2019, it was only 4.97. And each of these was an increase from the year previously by at least 6%. At the time of research, Alibaba is trading at a price of 212.3 per share, and analysts have an average price target of 301.6 per share. This shows that there's a 42.06% upside to this target, although these are just analyst recommendations. On the low end, analysts are projecting a price share of $270, and on the high end, $350. It is important to note that every year since the IPO, Alibaba has been able to increase their free cash flow. We know that Alibaba is a cash flow positive company. However, it is important to investors that companies continue to grow their free cash flow, because down the line, that will give the company options to expand and or start distributing a dividend. And now, lastly, we have the negatives. Founded in 1999 as a platform for small businesses to sell their products via the internet, Alibaba has since expanded far beyond e-commerce. It's ventured into many other industries, such as cloud computing and entertainment, but make no mistake, e-commerce is by far the largest Alibaba segment, generating 80% of the group's annual revenue. This business is also highly profitable, delivering $29.7 billion in adjusted earnings before interest, tax, depreciation, and amortization, EBITDA, in fiscal 2020. Alibaba is an increasingly competitive e-commerce industry, and intensifying regulation scrutiny in the US and China is a cause to the low current share price, as the news of that dropped them significantly, along with some fines from the Chinese government. Speaking of the fine, the Chinese government says it is issuing a $2.8 billion fine on the e-commerce company, Alibaba Group, for violating its anti-monopoly regulations. Alibaba is one of the most influential tech giants in China and the world, and the company was under investigation by the Chinese government since December for suspected monopolistic conduct. In a statement Saturday, China's State Administration for Marketing Supervision described the company's behaviors as having eliminated and restricted competition in the online platform service market, as well as having infringed on the businesses of the merchants on the platform. The fine is about 4% of Alibaba's total 2019 sales in China, which was 456 billion yuan, or $69 billion. This fine came after months of complications for Alibaba. In November, Alibaba's affiliate Ant Group was unable to jumpstart a seismic initial public sub-offering forecasted to raise $37 billion. The process was stopped by financial regulators in Shanghai and Hong Kong just 2 days before IPO was expected to list. So that wraps up Alibaba. If we had to give some general insight into what it's looking like, or just give you some keynotes and key takeaways, is that Alibaba is the number one in China for a reason. They have established a market share. They are still slightly profitable, and they're actually very profitable in their main market, but all of these other new platforms that they're getting into are still finding their way to being profitable and are taking away some of that. Their price to earnings compared to everything else is absolutely amazing. Their other competitors, and the fact that they have such a great market share advantage over the other companies such as JD.com is obviously something great to look for. You do have to worry though about the monopoly regulations in China, as that could be a big negative deterrent for a lot of people if it gets too serious. So the recommendation is make sure you make a smart play, pick it up at a cheap price, and look at what these regulations are going to be. Don't get stuck in something bad. This obviously isn't saying you should buy it or you shouldn't buy it, but make sure you play it careful, as this could be a very serious thing, and it's the reason that Alibaba is down over $100 since its highs earlier this year. So hopefully you did enjoy this video by DueYourDD. If you did, hit that like button down below. There'll be tags if you want to jump anywhere around on this video to see anything again and just look at it to see how it goes on. Hit that subscribe button. We are slowly working towards 1,000 subscribers, and these videos take a lot of effort to put in between the researching, the editing, and all that sort of stuff. So please, a like, a subscription, anything like that really help us out. And you can check out any of our other links such as Twitter, Patreon, and things like that down in the description. Anyway, hope you have a great rest of your day, and make sure to do your DD.